The thing that makes you wonder is the key. In the high-stakes, adrenaline-fueled Coliseum of Wall Street, where billions of dollars change hands in the blink of an eye and the air is thick with the scent of ambition and fear, there exists a persistent, uncomfortable silence surrounding a single, provocative image. Imagine a boardroom lined with mahogany, populated by the sharpest minds from Harvard and Wharton. Men and women armed with supercomputers, intricate algorithms, and decades of experience. They are the masters of the universe, analyzing charts, dissecting balance sheets, and predicting the future of the global economy. Now, imagine opening the door and letting in a chimpanzee. This primate is blindfolded and handed a fistful of darts. He throws them haphazardly at the financial pages of the Wall Street Journal pinned to the wall. The sensational, terrifying assertion of Burton Malkiel in A Random Walk Down Wall Street is that the monkey's portfolio will perform just as well, if not better, than the carefully curated selections of those high-paid experts. This image is not merely a joke, it is a declaration of war against the entire financial industry. It suggests that the emperor has no clothes, that the skill of stock picking is an illusion, and that the market itself is a wild, untamable beast that moves with the unpredictability of a drunkard stumbling through the snow. This is the concept of the random walk, and to understand it, one must first journey through the graveyard of arrogance where the smart money has been buried time and time again. The narrative begins by stripping away the veneer of order that Wall Street tries to project. Malkiel introduces us to the two great religions that have divided the financial world for a century. On one side stands the firm foundation school, a stoic and logical sect led by figures like John Burr Williams. They believe that every asset has an intrinsic value, an anchor in reality. They argue that a stock is worth the present value of all the cash it will ever generate in the future. To them, the market is a rational weighing machine. If a stock falls below its firm foundation, you buy; if it rises above, you sell. It sounds perfect, sensible, and safe, but opposing them is the castles in the air school, a flamboyant and cynical sect popularized by the legendary economist John Maynard Keynes. Keynes argued that intrinsic value is irrelevant because nobody really knows what the future holds. Instead, the market is a beauty contest. The goal is not to pick the girl you think is the prettiest, but to pick the girl that the crowd will think is the prettiest. It is a game of psychology, of anticipating the mob's whims, of building castles in the sky before the clouds dissipate. Malkiel takes the reader by the hand and drags them through history to show that while the firm foundation theory sounds nice in a classroom, the castles in the air theory is what actually rules the streets. To prove the insanity of the crowd, the story transports us back to the damp, gray streets of 17th-century Holland, the setting of the first great financial madness, tulip mania. The narrative paints a vivid picture of a society that lost its collective mind. It began innocently enough with a virus that caused tulip petals to streak with beautiful, flame-like patterns. Suddenly, these flowers were not just plants, they were symbols of status. The price of bulbs began to rise. At first, it was rational, rare things are expensive. But then, the castle in the air began to rise. Chimney sweeps, aristocrats, and maid servants all rushed into the market, not because they loved flowers, but because they believed the price would go up forever. Malkiel describes the fever dream where a single bulb of the Semper Augustus variety was sold for the price of 12 acres of land, a carriage, and horses. People sold their homes to buy roots. The sensation of greed was so blinding that a sailor, mistaking a rare bulb for an onion, ate a fortune with his herring, an act of accidental financial nihilism that serves as a grim metaphor for the era. Then, the inevitable happened. The psychology shifted. One person decided to sell. Then another. The castle in the air evaporated. Prices collapsed to zero. Lives were ruined. Fortunes vanished into the compost. And the Dutch economy was left in shambles. The lesson analyzed here is the greater fool theory. During a bubble, people buy overpriced assets not because they believe in the value, but because they confidently expect to sell them to a greater fool at an even higher price. But eventually, the market runs out of fools. The narrative then leaps across the English Channel to the 18th century. To the South Sea bubble. Proving that financial lunacy is not a Dutch anomaly but a human condition. This chapter introduces a tragic hero, Sir Isaac Newton. The discoverer of gravity, a man of supreme intellect, was drawn into the frenzy of the South Sea Company, a firm that promised untold riches from trade in the New World despite having no real business operations. The stock soared on pure hype and rumors. Newton, sensing the madness, sold his shares early and made a handsome profit of £7. But then, he watched as the stock continued to climb. He watched his less intelligent friends become richer than him. The envy, the most dangerous emotion in investing, gnawed at him. Unable to resist the siren song of the crowd, Newton jumped back in at the very peak, investing his entire fortune. When the bubble burst, the smartest man on earth lost £20, millions in today's money. He spent the rest of his life forbidding anyone to speak the words South Sea in his presence. Malkiel uses this tragic anecdote to drive home a terrifying point. Intelligence is not a shield against market irrationality. If the man who calculated the orbits of the planets could be seduced by a castle in the air, what chance does the average investor have? The analysis here is crucial. The market is not a calculator, it is a mood ring. When the mob is euphoric, logic is suspended, and gravity is ignored until the moment the ground rushes up to meet the fall. Moving into the 20th century. The script explores the Roaring Twenties and the subsequent crash, but focuses heavily on the tronics boom of the 1960s. This era mirrors the modern tech bubbles with uncanny precision. Any company that had the suffix tronics or onyx in its name saw its stock price double or triple, regardless of whether it made a profit or even had a product. It was a linguistic bubble. Malkiel recounts the story of a company whose stock soared simply because it announced it was using a new technology, only to crash when it was revealed the company essentially did nothing. This leads into the Nifty 50 craze of the 1970s, where institutions, the so-called smart money, decided that there were 50 one-decision stocks like IBM, McDonald's, and Polaroid that you could buy at any price and hold forever. Valuations reached the stratosphere, with price-to-earnings ratios hitting 80 or 90. The logic was the firm foundation, these were good companies. But the castle in the air was the valuation. When inflation hit and the mood soured, these blue-chip giants lost 80% of their value. The lesson analyzed in this segment is that a great company is not necessarily a great investment if you pay too much for it. The one decision stocks turned out to be a disaster because the market eventually demands that the price reconnect with reality. As the narrative weaves through these eras of delirium, Malkiel begins to dismantle the tools that investors use to try and tame this chaos. He turns his critical gaze toward technical analysis, the art of reading charts. This is the domain of the chartists, the modern-day shamans who believe that history repeats itself in predictable patterns. They look for head and shoulders formations, resistance levels, and moving averages. They believe that the stock market has a memory, that a stock wants to go up or down based on where it has been. Malkiel compares this to a superstitious gambler at a roulette wheel who bets on black because red has come up 5 times in a row. He introduces the random walk theory in its full glory here. A random walk means that future steps cannot be predicted by past steps. To prove this, Malkiel had his students generate fake stock charts by flipping coins, heads for up, tails for down. When he showed these purely random charts to a famous technical analyst, the analyst's eyes lit up. He immediately identified bullish signals and breakout patterns and asked which companies these were so he could buy them. When Malkiel revealed they were coin flips, the analyst was humiliated. The sensation of this reveal is profound. The patterns we see in the market are often the same patterns we see in clouds, projections of our own desire for order in a chaotic universe. The analysis of technical analysis goes deeper, exposing the self-fulfilling prophecy. If enough people believe a stock will go up when it hits $50, they will buy at $50, causing it to go up. But this only works for a moment. Eventually, the random influx of news, a war, a drought, an invention, shatters the pattern. Malkiel argues that technical analysis is anathema to the academic world because it has no basis in logic. It is akin to astrology. The chartist is always looking in the rearview mirror while driving a car at high speed into a fog. They can tell you exactly where the road was, but they have no idea where the cliff is. This segment serves as a brutal awakening for anyone who thinks they can time the market by looking at squiggly lines on a screen. The random walk asserts that short-term price movements are mathematically nearly identical to chance. The market does not care about your lines, it reacts to new information. And new information is, by definition, unpredictable. The story then pivots to the rival camp, fundamental analysis. If the technicians are the astrologers, the fundamentalists are the surgeons. They dissect the balance sheets, analyze the profit margins, and interview the management. This is the realm of Benjamin Graham and Warren Buffett. Surely, Malkiel argues, this must work? The narrative acknowledges that this method is more rational. But it is fraught with three fatal flaws. First, the information and analysis may be incorrect. Second, the analyst's estimate of value may be incorrect. But the third and most sensational flaw is that the market may not agree with you. You might correctly calculate that a company is worth $100, but if the market, in its castle in the air, madness, decides it is worth $50, you can go bankrupt waiting for the correction. Furthermore, Malkiel exposes the accounting games played by corporations. He tells stories of companies that smooth their earnings, hiding losses in bad years and banking profits in good years to create the illusion of steady growth. The fundamental analyst is often analyzing a fiction written by a creative accountant. The intensity builds as Malkiel uncovers the conflict of interest that rots the core of Wall Street research. The analysts who appear on TV, telling you to buy, work for banks that need to sell stocks to the public. He reveals a shocking statistic: at the height of the dot-com bubble, with thousands of stocks crashing, less than 1% of analyst recommendations were sell. They are cheerleaders, not referees. They are paid to keep the carnival going, to keep the castle in the air, floating just long enough for the insiders to cash out. The narrative paints the individual investor as a sheep walking into a slaughterhouse run by wolves in Armani suits. The smart money is not smart because they know the future, they are smart because they know how to manipulate the present. As the first part of this journey concludes, we are left standing in the wreckage of history's bubbles, holding a chart that means nothing, looking at a balance sheet that might be a lie. The random walk theory has stripped us of our illusions. We realize that the market is a mechanism of almost infinite complexity and randomness. The blindfolded monkey is not just a joke, he is a prophet of humility. But if we cannot predict the prices, and we cannot trust the experts, and the market is a minefield of bubbles, is there any hope? Is the only option to put our money under the mattress? The answer, Malkiel teases, lies not in conquering the market, but in understanding its efficiency. We are about to enter the realm of modern portfolio theory and the birth of the index fund, the boring, unsexy, yet miraculously effective weapon that the monkey unwittingly handed us. The darkness of the random walk is about to be illuminated by the light of a new strategy. One that accepts the chaos rather than fighting it. If you understand this, the rest is simple. We are stepping out of the chaotic carnival of bubbles and into the cold, sterile laboratory of modern finance, where the random walk transforms from an insult into a mathematical law. The narrative pivot rests on a single, towering concept that divides the financial world into believers and heretics, the efficient market hypothesis, EMH. Imagine a giant supercomputer, fed by millions of cables stretching to every corner of the globe. Every time a CEO whispers a rumor, every time a factory burns down in Malaysia, every time a consumer buys a new iPhone, this computer instantly processes the data and updates the price of every stock to reflect this new reality. Malkiel posits that the stock market is this computer. It is so efficient, so fast, and so ruthless that no single individual can consistently beat it because the information is already baked in to the price before you can even click your mouse. This is the sensation of the no free lunch. If a stock is undervalued, Thousands of hungry professionals, the arbitrageurs, will spot it and buy it, driving the price up until it is fair. If it is overvalued, they will sell it until it falls. The market is a self-correcting organism that leaves no $100 bills on the sidewalk. This analyzes the futility of the active manager. If the market is efficient, then paying a fund manager 2% a year to pick stocks is like paying a weatherman who predicts yesterday's weather. They are charging you for information that is already free. The story then introduces the Nobel Prize winners. We meet Harry Markowitz, the father of modern portfolio theory, MPT. Before Markowitz, investing was a cowboy's game of picking the best horse. Markowitz changed the perspective from the horse to the herd. He proved mathematically that by combining risky assets that move in different directions, diversification, you can actually reduce the overall risk of the portfolio without sacrificing return. This is the only free lunch in finance. Imagine an umbrella seller and a sunscreen seller. On rainy days, the umbrella stock soars and the sunscreen stock crashes. On sunny days, the reverse happens. If you own only one, your wealth is a roller coaster. If you own both, your wealth is a steady, upward line. The narrative uses this to hammer home the necessity of broad diversification. The random walk is dangerous if you walk alone. But if you walk with the entire market, the randomness cancels itself out, leaving only the steady drift of economic growth. But the narrative intensity builds as Malkiel introduces the concept of risk in a new light. We usually think of risk as losing money. Wall Street thinks of risk as beta. The capital asset pricing model, CAPM, emerges as the new gospel. It separates risk into two buckets: unsystematic risk and systematic risk. Unsystematic risk is the specific stupidity of a single company. The CEO steals the money. The product explodes. The warehouse burns down. The market will not pay you extra for taking this risk because you could have easily avoided it by diversifying. Systematic risk, however, is the risk of the entire system collapsing, war, recession, pandemics. This risk cannot be diversified away. Therefore, the market must pay you a premium for taking it. This is beta, a measure of how much a stock swings relative to the market. A stock with a beta of 1.5 moves 50% more than the market. It is a wild ride, and thus should offer higher returns. A stock with a beta of 0.5 is a sleepy utility company. It offers safety but lower returns. The sensational takeaway for the seeker is that trying to get high returns without high risk is a fool's errand. The iron law of risk and return dictates that if you want to eat well, you must be willing to sleep poorly. However, the story takes a twist. Just as the academics were celebrating their perfect mathematical models, a new tribe emerged from the psychology departments, the behavioral finance theorists. They looked at the efficient market hypothesis and laughed. They argued, the market might be mathematically efficient, but it is populated by emotionally retarded humans. Malkiel acknowledges this challenge, diving into the irrationality of the investor. He explores overconfidence, the reason why men trade 45% more than women but earn significantly lower returns. He dissects loss aversion, the biological wiring that makes the pain of a $100 loss feel twice as intense as the joy of a $100 gain, causing investors to hold onto losing stocks too long, praying for a rebound, and sell winning stocks too early, fearing the profit will vanish. He exposes the herd mentality that drives bubbles. The narrative here is a psychological thriller. It suggests that even if the price is right, the people are wrong. But Malkiel executes a brilliant judo throw. He argues that while people are irrational, the market is still hard to beat. Why? Because human irrationality is not predictable enough to exploit. Sometimes the crowd overreacts. Sometimes it underreacts. Unless you are a psychic psychiatrist, betting against the crowd is just another form of gambling. The random walk survives the psychological assault. The flow carries us to the smart beta revolution. Wall Street, realizing that simple index funds were killing their fees, invented smart beta funds that try to mechanically exploit these psychological quirks. They tilt portfolios toward value stocks or momentum stocks. Malkiel views these with the skepticism of a seasoned detective. He warns that these are often just active management in drag. They rely on data mining from the past. Just because small cap value stocks outperformed in the last 20 years does not mean they will in the next 20. In fact, once a factor is discovered and published, money floods into it, and the advantage disappears. This analyzes the self-destructing prophecy of market anomalies. The market is so competitive that any secret to wealth is destroyed by the very act of using it. The seeker is left with the realization that the more complex the strategy, the more likely it is to fail or be eaten alive by transaction costs and taxes. The narrative momentum shifts to the dark side of the industry costs. If we accept the random walk, that returns are essentially a coin flip, then the only variable we can control is the cost of playing the game. Malkiel unleashes a blistering attack on the mutual fund industry. He shows that the average actively managed fund charges 1% to 2% a year. This sounds small, but over 30 years, it eats up 30% to 50% of the final pot. This is the tyranny of compounding costs. The archetypal fund manager drives a Porsche not because he is a genius, but because he is a toll booth operator taking a cut of your money whether you win or lose. The index fund, championed by Malkiel and his contemporary John Bogle, charges 0.04%. It is the Costco of investing, bulk buying the entire market at rock-bottom prices. The sensation of switching from a high-fee fund to an index fund is like cutting a hole in your parachute versus gliding on a thermal. The performance difference is mathematically inevitable. We then descend into the bond market, often ignored by the thrill seekers of the stock exchange. Malkiel describes bonds as the ballast of the ship. They are not there to make you rich, they are there to keep you from drowning when the waves get high. He explains the seesaw relationship between interest rates and bond prices. When interest rates go up, bond prices go down. This is a critical mechanical detail few notice. If you hold a bond paying 2% and the new bonds pay 4%, nobody wants your old bond unless you sell it at a discount. The analysis here warns the seeker against the illusion of safety in long-term bonds during inflationary periods. The random walk applies to interest rates as well. Predicting the Federal Reserve is just as hard as predicting Apple's earnings. The intelligent asset allocator holds bonds not for yield, but for negative correlation, hoping they zig when stocks sag. The story approaches the practical life cycle guide to investing. We are conditioned to think there is one best portfolio, but Malkiel reveals that the best portfolio depends entirely on time. He introduces the sleeping scale. The young investor, with human capital, future wages ahead of them, can afford to take massive risks. If the market crashes 50% when you are 25, it is a gift. You can buy more cheap stocks with your next paycheck. But the 65-year-old retiree has no human capital left. A 50% crash is a death sentence for their lifestyle. The narrative outlines the glide path, starting with a heavy allocation to stocks, perhaps 90%, and slowly, methodically shifting into bonds and cash as the finish line approaches. This is not about market timing, it is about risk capacity. The sensation of age-appropriate investing is the peace of mind that comes from knowing your portfolio matches your biological clock. The second part of this journey has dismantled the myths of the smart money. We have seen the efficient market swallow the stock pickers whole. We have seen modern portfolio theory replace the cowboy intuition. We have learned that risk is the price of admission, and beta is the ticket. The air is thick with the realization that the financial industry is a theater designed to distract you from the simple truth. You are better off buying the whole market and firing the experts. But the final challenge remains. How does one actually construct this portfolio in the modern world? What about real estate? What about gold? What about crypto? And how does one maintain the discipline to rebalance when the world is panicking? The story prepares to descend into the final integration of these theories into a concrete action plan for the individual investor. The random walk is not a journey into chaos, it is a journey into the ultimate order of simplicity. The narrative now descends from the ivory tower of theory into the muddy trenches of practical application. We are overlooking the most important thing. Knowing the map is useless if you do not know how to walk the terrain. Burton Malkiel provides the Walker's Guidebook, a set of concrete instructions for constructing a portfolio that can weather the storms of uncertainty. The story shifts to the asset allocation strategy. It is not enough to simply buy the S&P 500 and pray. The world is a big place, and the United States, while powerful, is not the only engine of growth. Malkiel introduces the global citizen archetype. This investor understands that while Wall Street might be stagnant, the markets in emerging economies, China, India, Brazil, might be booming. By broadening the index to include international stocks and emerging markets, the seeker lowers their risk further. If the US dollar collapses, the foreign assets rise. This is the geopolitical hedge. The sensation of owning the entire world provides a psychological fortress, no matter who wins the global economic war. You are on the winning side. The flow carries us to the real estate puzzle. For the average person, buying commercial real estate is impossible. You cannot buy a shopping mall or an office tower. But Malkiel introduces the right real estate investment trust. This is the democratization of landlordism. By buying a right index fund, the seeker gains all the benefits of real estate, rent collection, inflation protection, without the nightmare of fixing toilets at midnight. The narrative positions real estate not just as a growth asset, but as a critical inflation shield. When the cost of living rises, rents rise, and the right investor gets a raise. This analyzes the hard asset component. In a world of paper money printing, owning a share of physical concrete and land is the anchor that keeps the portfolio from drifting away in the inflationary tide. Then, the narrative confronts the siren song of the shiny objects, gold and collectibles. Malkiel adopts the persona of the rational skeptic. He tells the story of the gold bug, the doomsayer who hoards bullion waiting for the apocalypse. Malkiel argues that gold is a fear trade, not an investment. It produces no cash flow, pays no dividends, and creates no value. It merely sits in a vault and looks pretty. Its price is driven entirely by the castle in the air psychology of panic. While a small amount might serve as insurance, betting the farm on gold is betting on the end of the world. Similarly, he dissects the art and wine markets, revealing them to be playgrounds for the super rich, riddled with high fees, illiquidity, and fraud. The lesson for the random walker is clear. Stick to productive assets, things that generate cash flow, and avoid sterile assets that rely on the greater fool. The story intensifies as we encounter the discipline of rebalancing. This is the only free lunch in finance. But it tastes terrible. Imagine a year where stocks soar 30% and bonds crash 10%. The greedy brain wants to sell the bonds and buy more soaring stocks. The random walker does the opposite. He sells the winning stocks and buys the losing bonds to restore his target allocation. This is the sensation of counterintuitive courage. It forces the investor to sell high and buy low systematically, stripping emotion from the equation. The analysis reveals the rebalancing bonus. Over time, this mechanical act adds a small but significant percentage to returns, simply by capitalizing on the market's mean reversion. It is the judo move that uses the market's own volatility against it. The narrative then addresses the taxman, the silent partner who takes a cut of every win but shares none of the losses. Malkiel advises the seeker to treat taxes as a transaction cost. The smart walker uses tax-advantaged accounts, like IRAs and 401 kiloseconds, as their primary vaults. They perform tax loss harvesting, selling losing stocks to offset gains, turning investment failures into tax victories. The archetypal, tax-efficient investor realizes that it is not what you earn, but what you keep. By deferring taxes for decades, the seeker allows the miracle of compound interest to work on the government's money as well as their own. As the journey nears its end, the narrative tackles the great enigma of the modern era, cryptocurrencies. In later editions of the book, Malkiel addresses Bitcoin and its brethren. He views them through the lens of history, seeing echoes of the tulip mania, while acknowledging the brilliance of the blockchain technology. He warns that the asset itself has no firm foundation, no earnings, no dividends, no intrinsic value other than what the next person is willing to pay. He advises the seeker to treat crypto not as an investment, but as a speculation. If you must play with money you can afford to burn. The random walker does not gamble on digital lotteries. He invests in the digital infrastructure companies that will profit regardless of which coin wins. The story culminates in the 3 giant steps to financial freedom. Step 1 is saving. It is the humble act of spending less than you earn. Without this fuel, the engine cannot start. Step 2 is time. The narrative uses the rule of 72 inches to show that money doubles every 7 to 10 years in the market. The young investor has the superpower of time, the old investor has the burden of urgency. Step 3 is diversification. It is the only safety net in a random world. The final image is of the individual investor standing atop the ruins of the active management industry. He has no expensive suit, no Bloomberg terminal, and no inside information. He simply has a low-cost index fund, a monthly contribution plan, and the patience of a saint. And yet, he beats the hedge funds, the banks, and the gurus. He wins not by fighting the market, but by surrendering to it. Analyze the ultimate meaning that the book intends to convey. Asterisk. A Random Walk Down Wall Street is a manifesto for financial humility and passive supremacy. Asterisk. Burton Malkiel's core message is that the stock market is efficient enough to crush anyone who tries to outsmart it, but generous enough to enrich anyone who embraces it. The book serves as a scientific rebuttal to the entire financial services industry, proving that complexity is a sales tactic and simplicity is the path to wealth. It posits that because future prices follow a random walk, the best strategy is to own the entire path through index funds. The final lesson is one of empowerment. You do not need a guru. You do not need luck. You need a mirror to check your ego, a plan to check your emotions, and the discipline to do nothing when everyone else is doing something. The climax of this journey leads to a state of rational confidence. The seeker moves from the anxiety of the unknown to the certainty of the average. They realize that average market returns, compounded over a lifetime with low fees, result in extraordinary wealth. The sensation of ignoring the noise of the market becomes a superpower. The final revelation is that the monkey with the darts was not a mockery of the investor, but a mockery of the arrogance of Wall Street. The journey ends with the seeker realizing that the random walk is not a stumble in the dark, but a steady, inexorable march toward freedom, powered by the collective growth of the human economy. Invest in the market, not the manager. The only sure way to win the game is to own the casino.